Your buyers were ready to pull the trigger last month when the rates were around 6.5%.
I was ready before you were born.
But now that the rates have spiked to almost 7, are your clients getting cold feet? I'm Gurfinkel, and today I'm sharing the exact scripts and strategies I use to keep buyers in the market, even when rates jump. Scripts that have helped the agents I work with close over 50 million in transactions during such rate spikes. The historical perspective chart that changes everything. When the rates jump, most buyers panic because they lack historical context. This simple chart completely reframes the conversation. I show clients the 50-year mortgage rate history, highlighting that today's high rates of 6 and 7% are actually right at the long-term historical average. The ultra-low 2 and 3% rates of 2020 and 2021 were the historical anomaly, not today's rates, not normal rates. Just look at it more like a black swan event. For example, in the 1980s, rates hit 18%. In the 1990s, they averaged 8 to 10%. Even in the early 2000s, 6 was considered an excellent rate. So I tell clients the 2-3% rates were like a once-in-a-lifetime sale at your favorite store. Just because the sale ended doesn't mean you should never shop there again, right? Today's rates are simply back to normal pricing. The historical context immediately helps buyers see that today's market isn't broken, it's just normalized. This single chart has kept dozens of my buyers in the market when they were actually ready to quit. Payment comparison versus rate increases is something that I also routinely show a lot of the buyers to expose the real math of waiting versus buying now. I create a side-by-side comparison showing the following points. The current rent payment with the projected rent increases over the 5 years, typically 5 to 7% annually in most markets. The next point, mortgage payments at today's higher rate, as well as total wealth accumulation through equity over 5 years. For example, a client paying $2,500 in rent would pay $150,000 over 5 years with nothing to show for it. Even with a 7% rate on a $400,000 loan, they'd build about $50,000 in equity over that same period of time while having a stable payment. The key insight? Even if the rates drop later, they're still building wealth now instead of paying their landlord's mortgage. This comparison shifts the focus from perfect timing to starting the wealth building process regardless of rate fluctuations. The marry the house, date the rate reframing, powerful, yes, but we don't honestly know when the rates are going to come down. However, the bigger picture is, however you phrase it, you want the buyers to understand that they need to separate their longer-term housing decision from the temporary, current financing situation. I would tell clients that you're buying the house now. You can refinance the rates when they come down. The house is a long-term commitment, but your rate is something you can change when the market conditions improve. It works because it acknowledges that the right home in the right location is a rare find. Interest rates, however, are cyclical and will eventually come down. You can refinance your rate, but you can't renegotiate the purchase of a home you loved but lost. I reinforce this by sharing stories of clients who bought at a high rate in previous cycles, refinanced later, and are now sitting on substantial equity gains. For example, I had clients who bought in 2018 at 4.75, which seemed high then. They refinanced in 2021 at 2.875 and have gained $150,000 in equity. Had they waited for better rates, they would have missed that equity growth entirely. Here is another example. I had a client who bought with a down payment assistance program, 0 down, right before the COVID insanity and home sales. Yes, the rates were more like in the 6s, but guess what? The home appreciated through so much through the couple 3 crazy COVID years that we were able to refinance them out of the down payment assist into a conventional loan. They've gained over $70,000 in equity, and we lowered their payment by a few $100s a month by wiping out mortgage insurance and not just lowering the interest rates. So case in point is, The timing is never perfect. The rates are never perfect. But what you do need to understand is that that perfect house will not come along again. The refinance timeline calculator is something that I use to illustrate the concept and make it more concrete. It shows the buyers exactly how refinancing may work in their future. I create a personalized refinance timeline showing when the economists project rates might drop, typically within 12 to 24 months, how much they could save by refinancing at projected future rates, and the break-even period for refinance closing costs, including total savings over the life of the loan. For example, on a $400,000 loan at 7% dropping to 6% in 18 months would save about $250 per month. With refinance costs at about $3,500, this is just an example, the break-even would be about 14 months, making it worthwhile even if they only stay in the home for 5+ years. This concrete plan gives buyers confidence that they're not stuck with today's rate forever, making the current rate more palatable. Rate buydown options as temporary relief is another conversation. For buyers truly struggling with payment shock, temporary buydowns offer immediate relief while they wait for their income increases or refinance opportunities. I explained the 2-1 buydown structure, the 1-0 buydown structure. So let's talk about the 2-1 buydown. Year 1, the rate is 2% below the note rate. Year 2, the rate is 1% below the note rate. Year 3, rate returns to the note rate. For example, on a $400,000 loan with a 7% note rate, year 1 payments are based on 5% interest rate at $21.47 a month, saving $516 a month. Year 2, the payments go to 6% mark and $23.99 a month, saving $264 per month. And year 3, the payment at the note rate of 7%, $26.63 per month. The cost for this buydown is typically about 2.5–3% of the loan amount, which can often be paid by the seller as a concession or built into the loan if there is appraisal room. We can talk about that in more detail. This strategy works particularly well for buyers expecting income increases, young professional, residents becoming attendings, etc., or those confident in refinancing within 2 to 3 years. Now, are your buyers getting cold feet because of the rate increases? Send me their scenario and I'll create a personalized comparison showing them why buying now still makes financial sense. I'll provide you with the exact charts and scripts tailored to their situation that you can use to keep them engaged in the market. The link to my rate consultation form is in the description. Let's keep your buyers moving forward, even when the rates aren't cooperating.